Today, we're tearing into some seriously eye-opening source material to break down the hidden mechanics of our economy. The sources we're unpacking today outline what they're calling a literal corporate heist. It's a shadow industry that, according to the data, is systematically dismantling some of the most beloved brands on the planet.
Okay, let's dive into this. Think back for a second. You know those massive, trusted brands you literally grew up with? The ones that just suddenly vanished into bankruptcy?
Toys R Us, Bed Bath & Beyond. All those iconic local restaurants, and crazy enough, even local hospital networks. Just boom, gone, liquidated. The sheer speed of it is honestly staggering. Now, when these collapses happen, the media usually feeds us this really simple, kind of comforting story, right? Like, oh, they just couldn't compete with Amazon, or they totally failed to innovate. But the sources we're digging into today reveal a much, much darker financial reality. The data shows these companies didn't just die of natural causes. No, they were hunted.
Welcome to the world of private equity, although Wall Street insiders actually use a much more fitting name for it, Vulture Capitalism. According to our sources, these firms aren't out there building businesses or inventing the next big tech, not at all. Instead, their whole model relies on this slick financial strategy that's specifically designed to extract billions for a super small group of elites.
And the sheer scale of this, it's terrifying. Get this, private equity firms currently control over $12 trillion in assets globally. 12 trillion with a T. So today, we are going to completely break down their exact playbook.
Now, what's really interesting about all this is the core mechanism they use to actually pull this off. It's basically a glitch in our financial system called the Leveraged Buyout, or the LBO. If you want to understand a vulture capitalist, you absolutely have to understand this specific weapon.
So let's break this down with a super simple metaphor. Imagine you want to buy a $500,000 house. Normal people, we get a mortgage in our own name. But in an LBO, you borrow $450,000 from the bank and you force the house itself to guarantee your debt. If you miss payments, you don't go bankrupt. The house does. You just casually walk away. I know, it sounds totally absurd, but this is exactly how private equity acquires multi-billion-dollar corporations. Here is the absolute madness of the math. When these firms acquire a massive, healthy retail giant, they only use about 10 to 20% of their own actual cash, and the other 80% heavily borrowed bank debt. They're literally putting almost nothing at risk.
But here comes the fatal blow. Once that acquisition is complete, the private equity firm takes that towering mountain of debt and just dumps it directly onto the balance sheet of the company they just bought. Literally overnight, a perfectly profitable company starts suffocating, instantly drowning in hundreds of millions of dollars in interest payments.
Let's move on and see how this builds, because once the target is trapped under all that debt, the heist enters phase 2, the strip and flip.
All of a sudden, this company needs massive piles of cash just to pay off the Vulture's bank loans. So, cue the hyper-aggressive cost-cutting. The new owners swoop in, seize control, and start firing long-term employees. They slash wages. They completely gut customer service. To the general public, it looks like the brand is just struggling. But to the private equity firm, this is highly calculated, ruthless efficiency.
Then comes the real estate cash grab, also known as the sale-leaseback. See, a lot of these historic brands actually own their flagship stores outright. So the private equity firm forces the company to sell off all that incredibly valuable land for a massive, immediate injection of cash. The wild result? The company is now forced to pay sky-high rent just to stay in the exact same buildings it used to own.
And you might be wondering, where exactly does all that real estate cash go? Well, it definitely doesn't go toward paying down the company's debt. No way. It gets funneled straight into the pockets of the private equity executives. Inside the industry, they literally call this a special dividend.
Which brings us to the final stage of the getaway. Phase 3, rebranding failure as profit. At this point, the company is completely hollowed out. Zero assets left, crippling rent payments, a totally exhausted workforce, and of course, that mountain of unpayable debt. Inevitably, it files for bankruptcy. Let's ground this in some harsh reality. Just look at the 2018 autopsy of Toys R Us. Over 700 stores liquidated, 30,000 people out of work, and the public, reading the mainstream news, just assumed it was because of shifting retail trends or kids playing on iPads. But behind the curtain, the analysis clearly shows the private equity firms that bought Toys R Us didn't lose at all. During the company's long, agonizing decline, those firms managed to extract over $400 million in fees. $400 million! They walked away with absolute fortunes, while 30,000 hardworking people walked away with absolutely nothing.
And look, if you think this whole playbook only applies to places selling action figures and bath towels, think again. The target list is expanding. Private equity has silently crept into American healthcare, aggressively buying up local emergency rooms, veterinary clinics, and even nursing homes.
When this happens in healthcare, the consequences become deeply, deeply societal. The entire priority structure just totally shifts. Patient care, that's no longer the primary objective. The real objective becomes short-term financial extraction just to pay down that initial LBO debt.
So, the absolutely crucial point our source material makes is this. This right here is the ultimate evolution of financialized capitalism. It is essentially the legalized cannibalization of productive enterprises solely for short-term arbitrage. It's debt merchants dismantling the very foundations of the economy, completely from the shadows.
You know, the free market was supposedly built on this really simple promise. You build a great product, and you win. But the sources argued that in the era of the vulture capitalist, those rules have completely changed. As the analysis bluntly lays out, you don't need to build anything. You just need to know how to weaponize debt.
And honestly, until those rules of corporate ownership change, the ledger is always going to favor the vultures. So take a look around your town today. The grocery stores you shop at, the clinics you visit, the nursing homes your family actually relies on, who really owns them? And maybe more importantly, what is their actual playbook?